Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. You know, I've been talking about on the last couple shows an area of we work so hard to build assets and try to pay off our mortgages and try to be financially sound. And I wanted to talk the last couple shows and today's show on the insurance on how to protect the assets that we have. And that's our car insurance and our home insurance and our policies and how to even read them. So I started the three-part series with the question, if I asked each and every one of you who are listening on the show, on the radio, or watching on TV, what coverages, could you tell me what coverages you have on your car insurance? Could you tell me what coverages you have on your home insurance? And I know most of you, I said in the first show, nobody knows. I still think I'm pretty much right with that one, but I know I'm right with at least almost nobody knows. So if I ask you what limits of liability or what tort option do you have or what uninsured motorist option or first party benefits, I know I've lost most of you, but those policies are the only things standing in between you and a big lawsuit. So you have to take them more seriously than you do. And what I did, I'll reiterate what I had mentioned in the first two shows on this series was normally the only time you pull out your policies are to get quotes on them to get cheaper coverages for whatever you already have. But nobody looks at, and I'll use that term loosely again, what are the coverages that you have and are they even any good? And are they coverages that are appropriate for you and your needs? You know, when you have policies from 20 and 25 years ago that you've never re-looked at and updated the coverages, your lives have changed so much. Your jobs have changed. You're probably no longer in the same home. You might no longer be in the same job. You might be retired now when you were working. And here your insurance policies have followed you year after year after year, staying the same as they were when they first started because no one's looking at them. So that's why I brought this out on the show. I'm bringing them out to bring up topics and areas that might need addressed. So I'm going to continue on the automobile insurance side of this today, and I'm going to get into some of the other coverages that I didn't touch yet. So here's one, first party benefits coverage. Here's another one, comprehensive and collision deductibles. And here's a third section, rental reimbursement and towing. Now, the reason I'm hitting these sections, in my mind, I'm going down in the list of the automobile insurance policy the way you would read it. So if you all pulled out your policies and have followed in these three shows so far, you'll see I'm actually going down from the top down on the way your policies are organized. They start with liability, they then go to the uninsured motorist, they have the full tort or limited tort options in them, and I brought up the umbrella liability, which pertains to those sections. So leading further, and to me, they're the biggest sections, and I brought that up in the other shows. So now we get down to what I consider more the convenience coverages. And again, I'll use that term loosely because I said comprehensive and collision coverage on your car. Well, what that means to me is if you don't have that coverage, you don't have anybody paying to replace your car. So while I call that a convenience coverage, the reason I do that and say that is my basic principle and philosophy on insurance is it's worth us paying a premium every year to protect ourselves against the types of claims or accidents that we could not afford to absorb and might in fact wipe us out or be catastrophic should they occur, even though they're highly unlikely to occur. That if they did occur, we have to transfer that risk to another company because we can't afford to absorb that risk ourselves. It would wipe us out. So does that make sense? That means a necessity. That's a critical area in our lives that if it happened, we'd be wiped out. If you're in a car accident and you kill or permanently disable somebody else, you have a very high likelihood of getting a lawsuit that would take away everything you've built and earned for the rest of your lives, and you may have a lien or garnishing on your wages for your future income, no longer going to you, but going to that third party also. Wiped out, folks. Lose your home and all your assets. So to me, those are the catastrophic areas, right? So when we get into you lost your car, you know, I'm loosely saying that's a convenience coverage, but it would hurt. I mean, that's a lot of money. You have a car loan, and here you owe the next 4 or 5 years on a car loan that you know, on a car you no longer have because somebody stole it or it got totaled in an accident through your fault, and there's no one there to pay. So yes, it's very expensive, but it won't wipe you out. So that's where I'm drawing the line. So I'm loosely referring to those as convenient coverage. Well, get this. When you buy your coverages on your car insurance, before we get to this comprehensive and collision, I want to get to one that's a very murky coverage, and it's called first party benefits. Everyone looking at your policy, you'll see this coverage, but most people don't have any idea what it means. First party benefits, when they say on the policy first party, you, the policyholder, and your family are considered the first party. The second party would be someone else that you might hit if you were in a car and caused an accident or injury to somebody else. So you're the first party claim. So that's paying for your medical bills, your lost income due to your medical or physical injuries in a claim. That's you personally, not your car. It's life insurance, which is accidental death. It's income, which is disability income. It's medical insurance. So it is a coverage that most people don't understand, and nor do they even look at. You can start with the minimum required by the state. Do you remember on the liability what I said the minimum required by the state was? On liability, not first party benefits, 15, 30, and 5. That means you only have to protect yourself if you injure someone else in a car accident for the liability side that we talked about a couple weeks ago, up to the first $15,000 per person, $30,000 per accident maximum, aggregate limit is what they call it, or per occurrence, and $5,000 property damage. So you hit someone else's car or someone hits your car. Remember last week I talked about uninsured and underinsured motorists? That's an underinsured motorist, folks. That's somebody who carried the bare minimum and really doesn't have enough to cover anybody for anything that they cause injury to as a rule. Well, first party benefits, are you required in the state of Pennsylvania to carry it at all? Because remember last week I said uninsured and underinsured motorists, you're not required to carry that coverage at all. If you don't remember what that coverage is, go to last week's show. So this week we look at first party benefits. That's your medical bills. You'd say, what do I need medical coverage for? I already have health insurance. Well, some of you are saying, I didn't realize I had medical insurance coverage. Are you saying if I'm hurt in an accident and the other person's at fault, I still have to go to my own policy? Not really. I'm saying if you are involved in an accident, you're hurt and it's the other person's fault, the first $5,000 at least, the state requires, Pennsylvania, every state's different, requires you purchase and cover the first $5,000 of your medical expenses before you go after anybody else. It has to be paid under your own policy. Then you can go after everybody else. Now, some people don't have health insurance, right? Medical insurance. Did you know you can buy up to $1 million on the car insurance? And it's not very expensive. So if you don't have any health insurance, no medical insurance for whatever reason, you're laid off, you're unemployed, you just don't have enough money, whatever the reason, you can't qualify for it, whatever the reason, don't overlook first-party benefits coverage that you could purchase up to $1 million on your car insurance, and it's not real expensive. I'm going to throw out a number to you, but I know it's wrong. Everybody's different. But what if it was $200 for the whole year? Huh? And that's family coverage, not just individual coverage. So I know I'm bringing up areas nobody's thought of, nobody thinks about, but you're going without some coverages that are not expensive to buy. Now, what about some of you might look on your policy and you'll see $177,000. You'll see that limit. Most of you won't, but some of you will. And you'll wonder, where did that limit come from? That's actually a combined limit of like $100,000 on the medical and then so much for income and so much for accidental death, and it blankets up to $177,000. If you see that number, question yourselves, folks, where'd that come from? Do I need it? It probably can't be right. I either need more or I need less, you might say. So think about that and look at those coverages. Are you wasting money? Are you wasting premiums on a coverage you really don't need? If you already have good health insurance, you already have disability income at work, you already have adequate life insurance for the rest of your needs, you need to reevaluate this coverage. And you need to see, do we need more, do we need less? Now, this income coverage, if you're disabled in a car accident, the minimum you can get, if you do choose to buy the coverage, and you're not required to, you can get $1,000 a month for 5 months. And then you can go up to 15 months and $15,000 in 12 months and all that. So there are some additional limits that can at least cover you for a year or two that you can buy. I don't want any of you buying it who don't need it. I really don't want any of you not buying it who do need it. But if you do need it, I want you to reconsider the other areas of your life. Hey, wait a minute. Should we do this here on our car insurance to add the income? Or do I really need a disability income policy, even if it's a heart attack or a stroke or not just an accidental injury in a car? Maybe we better reconsider this. So think, folks, think as I'm speaking to you about these coverages. But that's an area that some of you have more than you need and others don't have as much as you need. And I bring that up because, remember, if you see coverages here that aren't tailored to your needs, it's time to reevaluate. Then you get to the next area of coverage, which is that comprehensive and collision coverage, and those are paying for your car if your car is damaged in an accident, is collision, and in any other physical damage to your car other than an accident with another car or object, as they say, like hitting a wall or a guardrail, would be comprehensive coverage. That's a deer accident, deer crossing your car. Even though it's collision with a deer, they consider it comprehensive. That's fire, that's theft, that's vandalism, that's windshields breaking. Things like that are all considered comprehensive. So you look at that type of a claim, you are allowed to cover on almost every policy only fire, theft, vandalism, the comprehensive. If your car is getting older and you don't want to pay the premium to cover collision coverage anymore, but you want to keep coverage for comprehensive or fire or theft. And that brings up another point. For all of you with collector cars who aren't, maybe they're antique autos, maybe they're not, and you want to take them off in the winter. You store the car in the winter. It may only be 5 years old, it may be 15 years old, it may be a classic, it may be an antique. I don't remember the rules for classic. It's probably 15 years you're allowed to get a classic plate and 25 years an antique plate. Check me on that, folks. I'm not sure that's accurate. But what you look at is, what about the 10-year-old car you know you're keeping? It's a convertible and you're only keeping it for the summers. So in the winter, you want to take it off your car insurance policy. So you call the agent, you say, take the car off. Are they going to question you mostly? Most likely, no. Take the car off. Okay. They won't even ask, did it sell? Is the plate still on the car? So folks, I'll caution you, when you take collision or comprehensive and collision off your policy, or the whole car off your policy, because you can call and ask for either to the agent, they take the coverage off. All it is they just put it into the computer. They said they take comprehensive and collision off, or take that whole car off the policy. If you have a loan on the car, or a lease, obviously, the loan doesn't allow you to take comprehensive and collision coverage off the car. But let's say you don't have a loan on the car. The car is old enough, it's paid off. So they let you take comprehensive and collision off. It's in the garage, and then your home burns down. That's a comprehensive loss to the car, folks. That's not contents in your house. And your car's gone. And you cared so much about that car, you were storing it every winter to protect it. So be careful here when you think, well, I'm not driving it, so I don't need to cover the car anymore. And how about some of you who call and take the whole car off, not just comprehensive and collision coverage over the winter, but the whole car. Hey, remove that car, I'll pick it up again, and I'll tell you when I'm bringing it out on the road again. And then you get a letter from the state right around Christmas to ruin your Christmas from the state, Department of Transportation, Pennsylvania, that says, we've been notified you took coverage off your car, but you still have a valid license plate, an active license plate, and it's required that you maintain liability insurance, at least to the minimum limits, to retain the plate. And since you do not, we are going to fine you, or whatever they're going to do now, and suspend your license, or whatever they do. And you try to explain to them, no, I just had it in storage, I had it at home. And they say, prove you didn't drive the car. Well, you can't, and you had the valid plate. So you did not return the plate back to the state, and you are required to maintain insurance 365 days a year. I'm not sure what the penalties are on that. They're pretty severe. I can't remember, and don't hold me to this. I think there's a 3-month penalty on something. I hate to say that they would. I can't remember what it is, but I know that if you know what it is, I wish I would have looked it up before the show, but I didn't think about bringing this topic up until the show, actually, until I'm speaking. But it's big. It's bad. You do not want that penalty of having a plate and didn't have insurance on that car. It's really bad. So you get that, it wrecks your Christmas, and you say, why didn't anybody tell me about that? And who are you mad at? Well, you can't be mad at yourself, because nobody gets mad at ourselves, so must have been the agent's fault, right, for not telling you this. They don't run the Department of Transportation. They're not supposed to know all the rules. You need to be responsible for yourself, so don't do that. If you have a plate, you must keep liability insurance on it, but you're not required to keep comprehensive and collision. But where's the car? If you care at all about the car and the value is high enough, comprehensive covers fire. And what if somebody stole it from wherever you stored it? So be very careful here with that, okay? Now, for those of you who have cars getting older, so the value is not that high, let's talk about whether or not to even keep comprehensive and collision coverage. Why would I bring this up? Some of you have 2 or 3 cars. That third car might be older and quite functional and doing very well, but it has 90,000 miles on it, and the insurance company might value that car if it was lost or stolen or totaled at only $2,000, let's say, $3,000, or it might only be salvage value, who knows. Well, if you're still paying premiums on that because that's a really good car and to you it's worth $5,000 or $7,000, but if anything ever happened to that car, you couldn't replace it, folks, you need to figure out what would the insurance company pay you for that car. Because if you find out it's only $2,000 or $2,500 and you're paying a premium of, I don't know, $150 a year for it, and you have a $500 deductible. So you pay 5 years, let's say, $150 a year. Let's just say that. So you're paying $750 over the 5 years to cover just those 2 coverages. Just pretend. And $500 deductible if the claim happens, you're at $1,250 until you break even. So if the insurance company pays you $1,250, they'll subtract your deductible, or if they value it at that, and you add up all the premiums you paid for the last 5 years, you're no better off or worse off than had you not insured it at all. Even if they pay you $2,000, you've only gained $750. So it gets to the point where you say, did I waste $150 a year, or whatever the premium is? It might not be that much. Here's my point. Look at these coverages and what you're paying for on your insurances. Because remember in the first show I said the $1 million liability umbrella coverage is maybe only $200 to $250 a year. And maybe I said in that show, in an upcoming show, I might show you ways to, by not giving up much in value, be able to restructure where you're spending the premiums on your car insurance to get better value for it and end up not paying any more than you're paying already and get an extra $1 million coverage for giving up not much at all. Well, this is one of those cases, folks. If your car is $2,000 or $3,000 in value and you can save maybe $150 a year, and I'm just guessing, would you maybe be smarter than spending $150 a year to cover $2,000 to move or shift that $150 a year to an umbrella policy? And now you've got $150 out of the way toward a $250 bill. And I'll help you in a minute, maybe find the other money. That first party benefits coverage or rental reimbursement or towing. So some of these, what I again call convenience coverages versus necessary coverages or necessities. So you look at that and say, wait a minute, are you saying if I get rid of comprehensive and collision on my car, if the car is only worth $2,000 or $2,500, and move that premium that I was spending to buy the umbrella coverage or increase my liability coverages, I might be able to do all that and keep my premiums the same and buy maybe another $500,000 liability coverage or $1 million. And I'm saying, yes, that's exactly what we look for. I don't know whether it can be done, but I'm teaching you on this show. Look at all the options available. You don't have to go insurance poor. When I talk about liability, and if you injure someone else and lose your house, you have 100, 350. Remember that I talked about in the first show? You can go up to $500,000 or even $1 million and maybe be at the same premiums you are now by reshifting some of the other much less critical coverages that you have. There's one more, folks. I'm out of time, but I'm going to squeeze this in. If you have a $250 deductible, look at a $500. If you have a $500 deductible, look at $1,000. Why? That might save you $75 a year. If it does, I want you to picture this. The only thing you're protecting or getting a benefit, if you have a $500 deductible and you go to $1,000, is the difference of the $500. Because you're already paying the $500 deductible based on what your policy is now. If you save $75 to go to the $1,000, all you're doing is costing yourself another $500 for $75 a year. So you're paying $75 a year to not have to pay the other $500. Folks, I'll just ask it this way and I'll wrap up the show. Would you pay $75 every year to insure your $500 TV? That's my only question. And would you do that for every item in your house? Would you do it? Because right now, if your TV falls over, it's not covered, folks. I'll get to that when I get to the homeowners policies. Your TV falls over, it's not covered. What? My TV's not covered? It's covered for fire and all. I'll get to that in another show. But would you pay an extra $75 just to cover a $500 TV? No, you wouldn't. So why would you then pay $75 just to cover so you don't have to come up with another $500? If that $75 might be the difference to be able to buy you toward the $1 million protection to keep your whole home and family assets safe if you injure someone else. All right, folks, we're out of time. Give us a call. I can help you navigate through all this. You don't have to learn all this yourselves. I give you this show. I appreciate your tuning in. I'll be back again next week with another edition of All Things Financial.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.